today. I'm Robert Folsom. Chicago's three-ring circus of over-optimism. The city of Chicago can be a nice place to visit, but I'm not sure I'd want to collect a pension there. Chicago's pension plans are chronically short of cash. Nearly 3 of every 4 pension dollar liabilities are unfunded, which adds up to a $28 billion shortfall. To make up the shortfall, the city borrows money via the bond market, and in turn it pays bondholders via tax revenue such as property taxes. Thing is, Chicago's property tax went up 10% last year, and next year, Mayor Rahm Emanuel is up for re-election. Long story short, Chicago has proposed what Forbes magazine called an alternate method of issuing bonds, namely pension obligation bonds. And these bonds would use future sales tax revenue as collateral, which somehow means a higher rating and a lower cost of borrowing. Chicago wants to issue $10 billion of these bonds. It would be the largest ever issue of its kind by a U.S. city. If that sounds ambitious, consider this. The proposal also includes investing the borrowed funds, presumably in the stock market, so as to get an investment return that is higher than the interest rate on the bonds. It is hard to describe just how many rosy assumptions are at work in this proposal. It's like a three-ring circus of over-optimism. To pay back pensioners, Chicago has to borrow against future sales tax revenue, plus pay back lenders, and put borrowed money in stocks and get an investment return higher than the interest on the debt. Now, we don't have a chart of this bond issue because it hasn't happened yet. We can show this chart, which shows that the state of Illinois itself remains at risk of a downgrade to junk bond status. The 5-year interest rate spread shows how much more Illinois must pay its bondholders versus the highest quality municipal bonds. Illinois hasn't been able to close the spread below this level for the past 3 years. So back to Chicago's latest bond scheme, the Wall Street Journal correctly pointed out that Detroit, Stockton, and San Bernardino all issued pension obligation bonds, and they all subsequently declared bankruptcy. The rhetorical question is, what can this be from Chicago but a classically symptomatic expression of an extreme peak in mood? Stay tuned. This chart from EWI's Murray Dunn appeared in the August 28th Interest Rate Pro Services. Please see below.